So today I'm going to go through, as was mentioned, volatility in digital asset space and why it doesn't need to be a hurdle. We'll talk, first of all, it's no secret that crypto is volatile, but I want to take a closer look at just, how volatile it is relative to other traditional asset classes and some of the structural underpinnings for that vol. Then discuss volatility as a potential opportunity for investors. If we can think about vol as an asset class, it stands to reason that investors can systematically harvest a risk premium associated with that asset class. So third section, we'll talk about some evidence-based ways to approach that problem. And then lastly, just commenting on kind of state of the world for crypto and what we're seeing. So it should come as no surprise, Bitcoin has been more volatile than basically every other asset class, with a brief period of oil and EM currencies. And while a lot of that is upside volatility, it's important to remember that there's a ton of downside volatility. And I'm definitely going to be coming back to this slide. So it's worth asking, first of all, why the vol is so high and, if it's likely to remain so. So the first of all is blockchain is emerging technology. And like all emerging technologies that are highly speculative, think about internet stocks in the 90s, biotech stocks, et cetera, blockchain squarely fits in that cohort. Secondly, quantitative easing, while technically has served to dampen volatility among traditional asset classes, has actually had the inverse effect in the digital asset space. Thirdly, China has had a much larger impact in crypto than it does in other asset classes. And with that, they're culturally very fond of what we in the West would consider to be extreme degrees of leverage. And then finally, the threat of regulation has and continues to loom large over digital assets. So first of all, new technology, again, Bitcoin or blockchain is a revolutionary technology and actually has a lot of parallels to what we saw in the 90s with the dot-com stocks. And similar to internet stocks in the 90s, blockchain and digital assets now show huge potential, but it's still relatively early. And a lot of the expectations are forward-looking. And so you get these, huge valuations and all the speculative activity associated with that. This is kind of a fun chart to show. It's a simple comparison. And generally, I'm kind of reluctant to show these kind of overlapping line charts with, different axes because the statistical inferences are not as robust as they appear. But the point is, again, we saw this movie play out before with the NASDAQ stocks in the late 90s. And, again, this is just kind of a perfect antidote to highlight that this is still a speculative technology. Now, I do want to say, though, I want to specifically address the actual utility of blockchain technology, because we still talk to investors and advisors that think that Bitcoin and crypto is a Ponzi scheme, it's going to zero, it doesn't provide any value. And that is just categorically false. The guys in the last panel did a good job kind of talking about something, demonstrating real world utility. And, it's very real. There's a ton of use cases, a ton of real companies actually using blockchain today, and the rate of innovation is fast. One of the best examples I like to give people is Coinbase versus Uniswap. So Uniswap is a decentralized exchange, provides much of the same functionality as Coinbase, but it is entirely governed by contracts, smart contracts deployed on the Ethereum blockchain. So it is truly a decentralized autonomous organization, and it makes real money. People are shocked when I show them this slide that there's real revenues coming in. I mean, it functions much in the way that a co-op would, where it's kind of owned by the the community. So and from there, I always like to back out at price to sales or price to earnings ratio, because you can own this governance token, much in the same way that you can own a share of stock in Coinbase. And so again, the point to be made is that the real world utility of blockchain and in this case DeFi is real. The numbers are big. So we passed the point where I think investors have kind of gotten over the fact that the use cases of blockchain are no longer theoretical or academic. It's real, it's here to stay, but it's very volatile. Impact of QE, again, like I said, normally quantitative easing has kind of muted volatility since 2008, much to the chagrin of active equity managers. With digital assets, however, it's interesting because it's actually, specifically this most recent stimulus contributed to speculative buying. Particularly in a landscape in which there, quote unquote, is no alternative, the so-called kind of TINA phenomenon. That's why we saw a lot of the stimulus check money go into risk assets, specifically crypto. What was especially interesting to us was the degree to which the stimulus checks appeared to go directly into opening new Robinhood accounts, which then went directly into crypto assets, specifically meme coins. So while difficult to quantify, we can definitely say with certainty that the stimulus contributed to speculative excesses in the crypto markets. Impact of China. This is a big one. China has always had an outsized influence in Bitcoin relative to other traditional markets, and this was because Chinese people were very early adopters of Bitcoin because it very simply represented an easy way to get around capital controls. This is also why the central government has always hated Bitcoin. But they are a big player. Chinese trading is and a lot of it is retail trading. They move a lot of weight around in the crypto markets. Now, up until a few months ago, this is changing though. Up until just recently, about 60% of the hash power running Bitcoin nodes was in China. And then interestingly, the Chinese central government stepped in very aggressively and basically just declared mining operations to be illegal. And they've kind of been rattling the saber to that effect for years. There was a saying in China that, the equivalent of, much thunder, little rain, kind of all bark, no bite. Well, this time they meant it. And that was, if many of you remember, that was the direct catalyst for the sharp sell-off that we saw back in May, which, when you combine, that crackdown with the massive amount of leverage in Asia, basically you had $1 trillion of value in the crypto asset market evaporating overnight. Coinbase and Binance both went down. Uniswap did not, by the way, it's worth mentioning. Bitcoin sold off $10,000 in less than an hour. So the point is, the China risk is very real. It's waning, but it's still big. Last is the impact of regulation. And again, the group just before made this point very well. It's the regulatory pressures are real. They've always loomed over the digital asset space, but we're seeing them ramp up, especially right now in Congress. And so, as long as there's uncertainty around what exactly that looks like and how the regulatory forces kind of settle in on digital assets, there's going to be continued volatility. So this is one of my favorite charts that I like to show people, because Bitcoin is often referenced as a digital version of gold because of its store of value, hedge against inflation, et cetera. And gold, it's worth noting, is not known for having an especially low volatility profile, but this shows to what degree Bitcoin is still orders of magnitude higher than gold when it comes to volatility. So again, the point to be made here is that Bitcoin is very volatile. It's likely to remain that way for the foreseeable future. So the question is, what can we do about it? How do we think about this? Next section, I want to hit kind of a couple of points. First of all, risk and return are linked. This is easy finance 101, but it's an important underlying concept. It's also important to be specific with what we mean by risk. And then also to understand that taking risk isn't bad. It's just that taking uncompensated risks as investors is bad. So that leads into, all right, how can we think about volatility as an asset class? And then last, how can we reliably harvest the premium associated with that asset class, specifically in the digital asset space? So this is, like I said, this is Finance 101, nothing new here. You've got kind of the efficient frontier for asset classes, starting with fixed income, moving into equities, and then emerging markets and private equity. This is actually from a Bridgewater paper called Engineering Targeted Returns and Risks, which I highly recommend. But like I said, the takeaway is simple here. Expected return is a function of risk. That's why it's called the risk premium. And that's what investors are presumably compensated for underwriting the risks associated with these different asset classes. But I want to get back to that definition of risk, which traditionally has been defined as the annualized standard deviation of prices. And that works well for most asset classes because most volatility is associated with a downward move in prices, downside volatility. There's some math as to why that's less effective for high vol asset classes, especially things like Bitcoin, where a lot of the volatility is upside volatility, which therefore kind of dilutes the efficacy of using annualized standard deviation of prices as a measure of risk in the Warren Buffett sense, who famously quipped that risk is quote unquote the potential of losing risk of capital. And so, if you look at it through the lens of drawdown, which is our preferred measure of measuring risk, particularly in high vol asset classes, it's a much scarier chart. And I specifically want to call out the crucial 50% drawdown line. And why that's crucial is another one of my favorite slides that I'm continually showing investors, which is, the math of drawdowns. And we've all seen this before, but it's important to understand that, it's no longer abstract. When you're down 5%, you obviously only need to be up 5% to get back to break even. As that number goes up, you've got to be up a little bit more because your denominator is lower. When you get to 50%, you've got to double your money. And again, this was, anybody who was around during the 08 sell-off, started kind of hearing this in kind of theoretical abstract terms, but in Bitcoin, it's very real, as is this and this. So, if you're down 90%, you've got to make 9 times your capital back just to get back to break even. And that's already happened in the crypto markets. The math of drawdowns is simple to understand, but it's easy to kind of shuffle it away in the theoretical part for most asset classes because it is theoretical. This red box here at the bottom of the matrix just is not a reality for most asset classes. It has been a reality for a lot of the time for Bitcoin. And so, it's important. This is a stark reminder that, this is not theoretical, especially for advisors and fiduciaries of risk capital. This is not theoretical. And so the point is, well, what can we do about it? So this leads us into thinking about volatility as an asset. We know fundamentally volatility, as I said, is a function of future uncertainty. And the risk of that uncertainty can be exchanged between parties. This is options. I always think it's interesting. The earliest recorded example of an option comes from a friend of Aristotle, who was able to forecast that there was going to be a vast olive harvest, based on what was then the novel study of astronomy. He didn't have the money to buy olive presses in town, so he went around and actually negotiated the rights to those olive presses at a future date. And of course, when harvest time came around, as Thales had predicted, he sold those rights. He sold those options to use those presses, and made money. So, we have a long history of options as an example of being a great mechanism for risk transfer. But it's important to understand, all right, well, what are you paying for that option? Price, of course, is going to be also a direct function of volatility. And that's just, the Black-Scholes model. So spoiler alert, options are expensive, especially in volatile asset classes. They're actually can be prohibitively expensive. And that's what we're seeing in Bitcoin. This is from this week. If you look at the implied volatility of at-the-money options, we see that it's 100%. That means that these options, the current price of these options is pricing in an expectation of future annualized volatility of 100%. And, as shown by the red line in this chart, Bitcoin is volatile, but it's not that volatile. So it's important to recognize too that this is a well-established behavioral bias. This is known as the lotto effect in finance, and this explains why investors are willing to overpay for options, as well as small cap stocks. This is the underpinning for the low vol risk premium. Investors are willing to bid up volatile stocks because they presumably represent this kind of emotional attachment to a bigger payoff. But what it means is that, options are prohibitively expensive for investors, especially in Bitcoin. And again, this is not going to be news to anybody who's looked at options and commodities complex, for example. So the question is, all right, well, what can we do to potentially harvest this volatility as investors? And the good news is we can build our own option. Specifically, we can use momentum-based rules to manufacture a similar asymmetric payoff profile associated with an outright option, in this case, a call option. Economist David Ricardo actually summarized this, very appropriately 200 years ago with what's now the popular adage, let your winners run and cut your losers. It's worth mentioning, by the way, he made a literal fortune following his own advice off the Battle of Waterloo. So, fortunately, the point I'm making here is academic finance has documented literally centuries of evidence in favor of, the efficacy of momentum as a risk factor, and specifically its ability to generate these convex payout profiles in volatile markets. This is another paper I highly recommend. AQR does an excellent job summarizing the 100 years of evidence. On our research website, idxinsights.com, we actually do an hour-long deep dive into the specifics, not only the research, but then also the mechanics of implementing a durable momentum strategy, complete with formulas and exactly how to do it. I'm going to spare you the boredom, except to do it at a high level right now. What we did is if you look at the 10 spider sector ETFs, very simple, rebalance every month according to their momentum score. If no sectors are demonstrating momentum, let's just decide to put that into cash. So we're engineering this in such a way that we can allow it to go 100% to cash. This is a very simple implementation, very simple, very durable implementation, kind of expressing what we've seen in the academic literature. And this is an interesting benchmark with which to start pricing volatility, in this case, in long-only equity space. We actually have this as an index, which is priced daily by S&P. So you can download this. It's on the website. You can download this index that codifies these rules and use it for your own analysis. So the point I want to show, though, is the power of applying a systematic, robust set of rules for controlling risk. Now, remember, this is an index, so we're not taking into account transaction costs and things like slippage, simulated performance, but in practice, this has proven to be very sufficiently low for actual accounts that we manage this strategy. And what you can see, what I want to call your attention to, is that you can harvest the momentum premium, specifically by avoiding the uncompensated risk. And so if we look at the drawdown chart, this red zone down here is what we would categorize as that part of the risk spectrum, which kind of conveniently happens to fall below 20%, drawdowns, of which investors just aren't being compensated for taking that risk. And you can see on the chart at the upside, you can still theoretically capture the upside while just avoiding a lot of that uncompensated risk. So what does this look like relative to using options? In 2019, we actually did a study that compared that index that I just talked about, the tactical sector index, relative to the S&P 500 buffer protect index, which is an index that just simply rolls out of the money put options. It's actually, for those of you that are familiar with the innovator defined outcome ETFs, this is the index methodology that those are based on. And so what you can see in these charts, we're looking at the monthly returns of the S&P 500 along the x-axis, and then the returns of the index on the y-axis. So on the left-hand side, we're looking at the returns of our IDX Tactical Sector Equity Index. On the right-hand side, we're looking at the returns of the S&P 500 Buffer Index on the y-axis. So two things jump out. First of all, the worst monthly return for the momentum-based index on the left is about down 9%. For the options-based index, it's closer to 13%. And you can see the momentum-based index demonstrates a convex payoff profile. It's very subtle, but it's there. The options-based index is actually concave. So what does that look like in practice? And again, we're looking at simulated performance over time, but you can clearly see the different, the outcome of these different rule sets, and specifically the cost of options to the total return over time is non-trivial. It weighs on the compounding of returns over time, shown there in the dark blue line. Whereas if you look at the momentum-based index, not only does it demonstrate a better ability historically of controlling drawdowns, and therefore our preferred definition of risk, but also keeping upside. So this is a good kind of research exercise. A couple of months later, some researchers over at Newfound, which is a fantastic blog and podcast, by the way, Corey Hopstein, I highly recommend it. They found a similar result, which is not surprising. Options are expensive. So the point to be made is, all right, if a momentum-based implementation looks effective at replicating this options payoff structure, but in a cheaper fashion, what does it look like if we just apply this to something like Bitcoin, an extremely volatile asset class where the options are prohibitively expensive? So we did that, and that's our risk managed Bitcoin index. Again, this is also on S&P. It can be downloaded. We encourage people to play around with it, put it into model portfolios, etc. We also have a paper on SSRN that, again, goes into the details of the construction of this index as it relates to the gold market. It's the same exact rule set, just in this case, it's applied to gold. But if we cut to the chase and kind of look at the outcome, here we go back to our scatter plot of monthly returns. And in this case, we're looking at returns of Bitcoin on the x-axis and the IDX Risk Managed Bitcoin Index on the y-axis. And now you see this convex option-like payoff structure is very pronounced. And again, that's a function of the inherent volatility of the Bitcoin as an asset class. So now we see an ability for this momentum-based approach to, synthetically manufacture a call option that we could then use to harvest the volatility of this asset in what we would call a risk-conscious way. And that's what this looks like over time. This is just the index relative to a long-only allocation to Bitcoin. And you see the idea here, the asymmetric payoff profile allows capital to compound more efficiently because you're not spending so much time in the red zone. So again, the point is, this is a powerful way to help mitigate risk of an extremely volatile asset class. And, this is something that as we've talked to advisors and institutional investors, when they start thinking about digital assets in general, it's, especially as fiduciaries, it's easy to, get excited by the asset class, and much in the same way that internet stocks in the 90s, there's an exciting story, it's a revolutionary technology, but, the risk is very real, and it's bigger than it was for the dot-com stocks. And so it's for practical implementation, at least the advisors and the institutional investors that we've spoken to, find that an approach like this, be it ours or, something else that can, kind of manufacture an asymmetric payoff profile can mitigate specifically the drawdowns, all of a sudden makes the asset class much more tenable for a broader set of investors. It's no longer just your high net worth individual clients that want to take a flyer on something. You can start to reliably and responsibly think about how this asset class might fit in more conservative portfolios. So last section, I'll talk a little bit about what we're seeing, the outlook for digital assets in general. First, I would like to encourage people to visit our website. Like I said, we consider ourselves researchers first and foremost. So we are always putting up information, research. We spend a lot of time talking to other thought leaders in the space routinely to kind of talk about things like this, what they're seeing. But specifically what we're seeing is, there was a sea change in 2020, and the guys in the last panel did a good job of talking about this, specifically in the DeFi landscape, which I'm not going to go into specifics about what that means, but you can think about it as the actual applications, the utility of the blockchain kind of serving these different functions, traditional finance functions. And with that, we saw, we started managing crypto portfolios for advisors, for third parties in 2019. And back then it was still, kind of early enthusiasts, hobbyists, people that were kind of curiosity seekers. In the back half of 2020, we started seeing real interest from, institutions, advisors, RIAs, thinking about it more broadly for more people. And part of that is the TINA effect. There is no alternative in an environment in which, the forward-looking prospects for traditional asset classes is very low. The threat of inflation or monetary debasement, global macro uncertainty is high. To some degree, investors are forced into looking at digital assets, even if it's not their first choice. I mean, we've heard a lot of conversations where people say, I'm not a big fan of Bitcoin, but all my clients are asking for it, so I have to have an answer. And we're starting to see more of that. That's not going away. And so again, we've always been proponents. We were not necessarily early evangelists of Bitcoin or digital assets as an asset class, but where we did have high conviction was, we would encourage people to not necessarily be resigned to long-only exposure for all your clients. That's not to say that every client everywhere should have risk managed exposure, but it just opens up, think about it, opening up a broader toolkit as advisors, as institutions, as fiduciaries, with which to include it in a portfolio. And the risks aren't going to go away. The regulatory risk is certainly not going away. China's going to continue to be a big player. One would hope that we're not going to continue to see stimulus money going to Dogecoin, but who knows? The volatility is likely here to stay, but it's a compelling asset class. It's a disruptive technology. And so at any rate, it's something we think it's increasingly important for advisors and institutional investors to take note of.
So Ben, you have some questions.
Yep, so let me, got it. So one question, Yeah, so specifically with the options, is that different from derivatives perpetuals? That's actually a good question. It is a little bit different, but it's very analogous. So Deribit, by the way, is one of the big decentralized options frameworks for transferring risk within digital asset space. And it's, one thing that's interesting is increasingly most people looking for risk transfer mechanisms within the digital asset space increasingly are going to decentralized protocols and exchanges. Like I said, I mean, even during Black Wednesday, fortunately we weren't trading. Our models were actually already in cash, which helped. But we went to the decentralized exchanges as part of the stress test, and just it was difficult to get access. And meanwhile, as an exercise, we transferred meaningful amounts across these dexes, and it was anybody that follows the digital asset space saw DeFi won the day as they saw. And so it's important to recognize that these are going to emerge. These decentralized protocols are going to emerge as real mechanisms for transacting risk. Another question: do you feel that exotic commodity valuation models could be a better framework for price discovery in the crypto markets? Yes, absolutely. And you started to see that. One of the things too, this segues into another question about what's interesting about blockchain is that it's transparent. So you can see a lot of so-called on-chain metrics. Something we look at very closely: wallet activity, wallet velocity. You can segregate it by size of wallet. It's interesting to look at what the so-called whale wallets are doing versus the smaller wallets. And it's a very rich ecosystem. It's a very rich data set for augmenting price discovery, but then also just the activity of the network in general. And so, a question about track record and fees. Yeah, I would say just contact us on the website, and we'll follow up specifically. Short answer is we've got trust for these strategies. And then another question: where are advisors starting to? Where are you seeing advisors starting to put this in asset allocation models? I mean, generally, what we've seen is this was in the alternatives bucket. Not surprisingly, we have started seeing, I think, more people, especially if you're looking at a lower volatility profile, a risk managed volatility profile of digital assets, seeing it to start to compete for gold allocations and commodity allocations. And so it typically, what we've seen anyways, it typically sits within the alternatives bucket as a proxy or a complement to gold and commodities. Last question: what are the greatest challenges to implementing strategies effectively? Greatest challenge right now is candidly just the vehicle through which people consume it. So we have SMAs that run the strategy using the Grayscale Bitcoin Trust, which only trades during market hours. A lot of Bitcoin activity is over the weekends. So that's actually one of the reasons we launched Trust, was so that we could trade over the weekend. And the example I give from last year was our models went long on a Saturday in July, and Elon Musk tweeted on Sunday, and GBTC gapped up 12% at the open. And so, over time, that that's not a huge effect, but it's not nothing. So there's a benefit to being able to transact, directly in things like Bitcoin itself.
Ben, we've got a few more questions that have come to me. So, what do you think is the future of the volatility, or just in general, the centralized exchanges versus the decentralized exchanges? How will that affect volatility?
That's a good question. I think the decentralized exchanges are really making a run at market share. If you go back to that slide about Uniswap, and that's just one example. I mean, you're starting to see, this isn't just hobbyists and individual traders transacting. I mean, you're seeing real institutions starting to trade on these dexes, as they're called. Ultimately, most of the volatility we're seeing, or at least we've seen, is there's still a lot coming out. It's important to differentiate U.S. centralized exchanges versus non-U.S. and specifically Chinese. There's always been an issue, back to the question about price discovery. There's always been a little bit of a weird issue with some of the numbers that come out of Binance. Some of the Asian-based exchanges. They're a little bit more aggressive too with changing margin rates and things like that. So, for example, a lot of people don't realize up until recently on Binance, you could get 100-to-1 leverage. And I was explaining that to somebody, and that's one of those things that's within the realm of theoretical. I mean, at 100-to-1 leverage, you can get wiped out instantaneously, and it's a very retail phenomenon over there. And so you start to see weird things as it relates to price discovery, price action, And so, and there's a lot of volume too. So on a volume weighted basis, there's a lot of power for potential disruption from centralized exchanges that might be less regulated than here in the States. I think last thing I'll say is, Congress is clearly looking at increased regulation on the exchanges themselves. I think they're looking at the DEXs as well. So you're going to see, I think you're going to see the regulatory apparatus descend on stable coins and exchanges first, and probably pretty heavily, which, I think will contribute to the vol. But the point to be made is, I don't think vol is going to go down. It's can vol go up much more than 100% annualized? Who knows? But the volatility is likely here to stay.
So another question is, how do you think the government can effectively go after the DEXs?
Well, that's a good question. So actually, we just did a podcast with some of the guys from Banker, which is one of the original DEXs in the space, and they're truly decentralized, and they've done a very good job of kind of building an institutional capability day one. But no, that's the question: is how do you go after something that's truly decentralized? If they have offices in the U.S. or Hong Kong or something like that. But I think the easy way to regulate crypto as a government is to go after the fiat on ramps. So how do you transact U.S. dollars into crypto? That requires a banking relationship. In the U.S. anyway, most of that sits within kind of decentralized exchanges like Coinbase. I think that's why you're going to see central banks in general, but the Federal Reserve in particular, start to aggressively pursue a digital currency. There was actually, the Fed released a great paper a couple of weeks ago about the era of private money pre-Civil War. So before the National Bank Act in 1863, a lot of people don't realize this. There was different currencies. The Bank of Philadelphia had a note, the Bank of Texas had a note, Bank of California had a note. They all had their own exchange rate, and theoretically they were all pegged to each other. But it looked very much like what we see in the world of private stable coins right now. Mm-hmm. And so I think that's a natural precedent for the government to intercede. And again, the question is, there's always the threat of too much regulation, but there's also a threat of no regulation. There's a happy middle ground. But back to the point about, and I think that's relatively easy for stable coins, which are largely kind of centralized actors, because there's generally a collateralization component. DEXs is tough. DEXs is tough to regulate.
But you say the on-ramp, so would that mean that the Coinbases of the world would they would stop people from transferring to DEXs? Still, even if you have centralized stable coins, once you're on Coinbase and you trade, how are they going to stop you from sending your crypto to a DEX?
No, exactly. That's exactly it. I don't know. It'd be very tough, if not impossible. And so that's the point: is once you get that stable coin, and that's the beauty of DeFi, is it's self-custody. So there's a lot of risks with that. The privacy, it's the security layers is more difficult. You can't rely on a third-party custodian. But once you've got your coins in your MetaMask wallet, you can go all over the world and do whatever you want to do. And so, yeah, I think regulating the DEX is going to be tough. The only way to do it, in my mind, would be find those in which typically there's a foundation, a more centralized foundation kind of associated with the actual protocol itself. And those, in some cases, have actual offices and people that are not anonymous. But it's not an easy thing to necessarily do. That's why I think you're going to see the regulators focus on centralized exchanges and stable coins.
If you have a few more minutes, we had another couple questions that were in. Did you have a few more minutes?
Yeah, absolutely.
Okay. Another one was, what area of crypto are you thinking will have the most volatility?
Well, I think some of these newer technologies like DeFi. So if you look at Bitcoin and Ethereum, they've been around for a while. The volatility, again, is certainly not low by traditional standards. But when you look at the landscape that's likely to have the highest volatility, but also I think the highest potential for return, it's going to be in DeFi. And so we actually very shortly, hopefully this month, are going to have a risk-weighted DeFi index, also priced by S&P. Because that's a space where I think the benefits of diversification are potentially going to be quite large. So not just the benefits of risk management, but also diversifying across the DeFi landscape, different protocols doing different things. I think that's potentially a really compelling source of, forward expected return for investors going forward. But again, those are the most untested and the smallest, smallest projects. And so again, they've got the biggest potential return, but a lot of volatility associated with that.
So another question is, do you feel that we will see more algorithmic trading because of the volatility and speed of these markets?
Oh yeah, I mean, yeah, no, we're active in that space. I mean, we have Solidity developers, we're developing our bots and things like that. One thing I'll say is traditional arbitrage, spot arbitrage is very efficient. I mean, it works well in the DeFi landscape because there's full transparency. So there's an active and a very large community of arbitrageurs out there, kind of ensuring smooth liquidity transfer across these different dexes. And I would argue that that's not contributing to volatility. It's the leverage, specifically out of Asia, where retail leverage is kind of ubiquitous and very high. Like I said, I mean, it's not uncommon. If you go on some of these chats, people think 20 to 1 leverage is low. Leverage is the big one where I think that has the biggest risk of exacerbating volatility in the future. If anything, I think the arbitrageurs and the algo traders are kind of helping not necessarily smooth volatility, but at least kind of smooth price discovery intradex.
So with all this intense leverage, do you see it? Is there a way that we could have a catastrophic market failure? Or
well, what's interesting is so during so-called Black Wednesday, when we had that massive sell-off, which again started in the overnight session with China, what was interesting was so a lot of these DeFi protocols that provide a borrowing and lending capability, and I'll give an example. Compound, Aave, we just had them on our podcast. I can go on there as a self-custodied holder of digital assets. I can go on there. I can stake my Ethereum, my Bitcoin, my stable coin, and I can take loans out against it. What's interesting is, let's think about that though. This is entirely decentralized. So all the rules are predetermined in smart contracts deployed, in this case, on the Ethereum blockchain, as are the liquidation triggers. And so what's interesting is when you look at traditional finance, historically, and this time around was no different, not in the US, but in the West, there were allegations of kind of predatory hiking of margin rates, where the centralized exchanges, were hiking margin rates in an attempt to specifically liquidate accounts for profit. We saw this in the hedge fund world back, for those that are old enough to remember convertible bond arbitrage hedge funds in 2005. You saw kind of predatory activities from central banks. 2008 for a lot of distressed loan and bank funds. On these DeFi platforms, the rules are codified, so exactly the rules of the game, what they are and what they're going to be. And so when the over collateralization level falls to a certain amount, you get liquidated. It's all rules based. And so I would argue the DEXs actually, technically these were DeFi platforms, not DEXs. The borrowing and lending platforms actually functioned really well and demonstrated a very positive use case for something that's so-called trustless and permissionless. The trust is, you're no longer trusting your counterparty, your prime broker, to do right by you when the chips are down, and we see this. I mean, anybody who's run a hedge fund that's had a prime broker relationship knows that you're always worried about, if you have a high vol asset class, what the margin rate is going to be. It changes all the time. When that's distributed on a decentralized permissionless ledger, nobody can change the rules on you. So it's actually, I think for that reason, you're going to start to see a lot more institutional capital kind of move that direction. And it's never going to be all one or the other, but I think they're going to coexist, kind of, DeFi applications with what they call CeFi, centralized finance applications. But that was, to your point, that was, Black Wednesday, as I call it, was a perfect use case of how, again, DeFi won the day in many respects.
So what are your thoughts on the rise of platforms that specialize in liquidity pools for institutional investors?
We are big fans of that. We are actively developing that space. I'm hoping that soon we'll announce some kind of partners in that space with some of these dexes. But I think Aave, in fact, again, on our podcast, when I talked to Ajit at Aave, he talks about this. They were the first to kind of make a big move into providing institutional access to liquidity pools. And I think it makes a lot of sense. And specifically what that looks like, the question is, all right, well, what's the big deal? If I can go provide liquidity on Aave or Banker or Balance or whatever, why can't the institutions? They can, but there's typically a higher standard for things like KYC, AML. And I always make this joke. In fact, when I hired one of my Solidity developers, last year, he was I said something like, we're going to have an agreement with everybody, a legal agreement with everybody, because we're regulated. They're going to be SEC regulated. And it just took him a while to understand that we weren't, transacting anonymously with people. We were using DeFi to harvest yield for them, but it was done, we knew who they were. And so I think, the institutions are already regulated. So for them, they want KYC, they want AML. And I think groups like Aave, groups like Banker are at the forefront of building and facilitating institutional participation, which isn't, which you can think of as kind of a permissioned layer on top of a decentralized application. So I think that's a huge area of growth. It's one we're very aggressively, very actively kind of building out and participating in. And I think it makes a lot of sense.
Another one was, what do you think the traditional like CeFi players will use? Like, what trends or technology will they be using from these DEXs?
That's an excellent question. I think the big area where you're going to start to see CeFi adoption is probably in the derivative space. That's where, looking at things like options, more exotic derivatives, insurance is a perfect example. Just kind of anything outside the realm of more traditional kind of exchanges. The rate of innovation in the DeFi landscape has just been, frankly, astounding. And I think that's where you're going to see kind of CeFi adoption, and then also wallets. I mean, a lot of the CeFi, Coinbase already has their own wallet. A wallet is kind of an easy entry point for a CeFi app to start to facilitate, to your exact point, transfer of coins in and out without having to open up, a separate application or something like that. And then I think you're going to start to see hybrid exchanges. And again, this gets a bit technical, and actually we have a podcast where we explain it better in depth. But centralized exchanges are typically order book focused. Everybody on Wall Street is familiar with that. These DeFi exchanges, oftentimes, because they have to bootstrap liquidity, it's not an order book. It's what they call an automated market maker, in which the exchange rate curve is predefined. And so there's some interesting nuances there. There's some interesting arbs there, candidly. But I think you're starting to see, in Uniswap version 3 is starting to actually integrate concepts and certain functionalities from an order book type market into what they call the AMM type market. I could see that innovation going the other way, where the CeFi exchanges start to innovate. But I think it's also in the derivatives where you're going to see a lot: options, perps, perpetual futures, and insurance.
Will your deck be made available?
Yeah, absolutely. The easiest thing is just contact us on the idxdigitalassets.com, and we'll follow up with these slides. And then, like I said, we have a ton of research on the site and podcasts and things like that too. And we're also happy to, like I said, serve as an educational resource. We talk to a lot of the people that really have no intention of ever buying crypto, but they want to stay up on the space and kind of understand certain concepts. We've got a team of people happy to help.
Awesome.